Welcome back to the Warlords of Wall Street. Well, today was a day for testimony up on Capitol Hill from the banking regulators, Treasury Undersecretary, Director of the FDIC, and pretty much everybody was pointing their fingers at each other over SVB and the problems in the regional banking sector. At the end of the day, the consensus essentially was that the Trump-era rollbacks on requirements was taken advantage by medium-sized banks, which is to be understood to a degree, but never let it be said that SVB didn't have a uniquely aggressive portfolio and were uniquely incompetent in managing their exposure, their bond portfolio's exposure to an increasing interest rate environment. The replacement and guarantees of deposits well beyond $250,000. It was revealed today that there's a handful of very wealthy individuals that had well north of $13 million. I believe they had mentioned as many as 30 or 40 individuals that were in the millions of dollars in exposed losses that are going to be made whole by the government. I think that's a little bit of a push on the government's part. That isn't the way the system is designed, and yet this is probably what good lobbying will do for you. You'll end up having favor in Washington, D.C. As the day moved on, we saw Alibaba, rumors of it being split up by the Chinese government into 6 to maybe 8 different new parts. That caused some excitement. I always have to take the Chinese ADRs, American Depository Receipts, with a grain of salt, because you're not really owning the share. You're owning the share of something that's been formulated offshore and has nothing really directly to do with the stock in the company in and of itself. And never let it be forgotten that every company in China that is publicly traded, whether it be here or anywhere else, is controlled to the greater extent by the Chinese Communist Party and its leaders over there. And who knows what exactly the reason why they're breaking up Alibaba and other companies like it, probably because the bigger something gets, the more powerful it is and the more influence it has. And that's just something that the Chinese just won't tolerate. Ma himself ended up disappearing a year and a half ago for quite a few months, just disappeared off the radar, and then showed up out of country and hadn't been back in China for the better part of a year. So it looks like his re-education, he is stepping to the party line now. And I'm thinking whatever lesson he was taught, it stuck. The Alibaba shares jumped almost 15% at one point today. And I would caution anyone who's looking at the Chinese stocks to keep in mind that, number one, they don't play by the same accounting standards that we do, and we like generally accepted accounting principles, GAAP as they call it, for its acronym, is that we want to know that we can trust the numbers. And frankly, you can't trust the numbers with Chinese companies. It's always been a dilemma. It's tough to ignore a company like Alibaba. It is progressive. It's doing a lot of good things over there. You just want to trust the numbers, but you can't. There's been decades and decades of accounting abuse and just out and out fraud on the Chinese companies' reporting practices. And so if you're going to play with the Chinese stocks, by all means, be very careful. Be very careful with them. The other big news of the day was we're beginning to see some of the earnings reports coming out. What happened today with Micron was a continuation in the saga that the chip manufacturing companies are having issues with their inventories. It missed on the top and the bottom lines, but it gave a modest outlook going forward over the next quarter or two. And as a result, they didn't get hammered in after hours. We'll just have to see how the market responds to that tomorrow. Uh, I'm curious to know. The tail that'll wag the dog is what NVIDIA says. NVIDIA is turning out to be the biggest player in the exact type of powerful chips that's going to be required to fuel the AI revolution. And what is possible in this new, incredibly interesting sector is that it could end up revolutionizing a great many things. The problem I have with NVIDIA is it's just so damn expensive per share from a fundamental point of view. I can't bring myself to buy it here, and yet you were watching it trickle its way up, and it's gone up so much over the last 6 months or so. I just can't. I'm waiting on a little bad news, and maybe we'll take a look at it. Maybe we won't. The good news continued with a couple of other stocks. McCormick came out, did a nice job with its numbers, gave some very positive forward guidance, and that I think is going to end up being the tail that wags the dog for all the companies. We're going to, since we're in such a precarious situation in the market right now, with worrying about inflation, the interest rate increases, will they continue? Will they abate? Who knows? But the one thing that we all can agree on is that if a company is going to come out and it ends up having a better reporting period right now, this quarter, than what was anticipated, if it comes close to what everybody thought, they estimated that its earnings might very well be, well, that's great. But everyone will be hanging on the commentary about what the forward guidance is, what's coming the next quarter or two, what's coming through the balance of the year. And if it turns out that the narrative is more positive going towards the end of the year, I think we can end up seeing a little more stability coming to the market. The only issue I have, and I've echoed this a number of times, the S&P overall is always going to be led by the mega cap stocks because of the weighting of their influence within the particular sector of that market in that particular index. But we also have to keep in mind that overall the PE is around 19, and that for me is just a tick or two too high. Some would argue that there's a great many within the S&P that are modestly valued. Well, that's true. However, you won't find those that are the ones that have the best credit ratings. And let us dive into that for a second. When you're dealing with difficult times in the market, quality matters. We've echoed that numerous times here. We are fundamentalists first and foremost before we lean back on the technicals of the market at any given moment. So when we're looking at the fundamentals, we're talking about looking at how healthy they are. Are sales continuing to go up? Are their debt levels at manageable levels? Is their debt in relationship to their cash and negotiable securities, that which could they easily pay off all of their debt if they wanted to? If they wanted to write a check, could they? There's not many companies that are capable of doing that. Not unlike when we were doing current ratios, talking about quick ratios and such, about a company's cash position. Do you have at least 1-to-1 ratio of what all of your current expenditures for the year are going to be? Can you get there and stretch that ratio to a 2? Which is much better. Can you get it to a 3? You'll find the ones that are well north of 2 and 3 in their cash positions also happen to be the ones that could theoretically pay off their debt, write a check for it, because they're managing their debt very well. Those well-managed companies also tend, that type of stewardship is recognized by the Moody's and the Standard & Poor's of the world. You're going to see a higher credit rating on them, and if you want one of our little part of our secret sauce, do spend a little time when you're looking at a company, add it to the soup, the gumbo that you're creating, and of all the little things you take into consideration before you buy a stock. One of the things that we take into consideration, what is their credit rating? If we're bank grade or better, triple B or better, and if you can get up into the single A range to the double A range, you're looking at an incredibly healthy and well-run company. And at times like this, when the market is volatile, quality means something. Cash flow means something. Cash management on the books, responsible borrowing, it all matters to the strength and resiliency of a particular company. And when you're left with the choice that a lot of the numbers may end up looking the same, but then you start looking hard at their cash position and what their credit ratings are, by all means, take the better credit rating. If that is always going to be the tiebreaker, take the quality, because it'll go down less in times of trouble, and they tend to go up more when things are good. So, just another little hint from your Uncle Pride here. The other little thing that we are watching out there right now is that there seems to be some overtures that commercial real estate could end up being greatly affected with the interest rates bumping up in the banks and the banks being very cautious about going forward. Commercial real estate loans typically tend to be fairly large, and that's the reason why the banks will be especially cautious about that going forward, because right now, these are troubled times. They're trying to do their best to manage their books, but big commercial real estate projects, higher interest rate environment, it's a bad combination. And yet, we're going to keep an eye on that, because that could end up being a leading indicator going forward, that if there's more and more trouble with people being able to borrow, that's going to have an effect on the economics of the market and the earnings going forward. So we'll be staying on top of that, and we'll be dropping little nuggets from time to time as we end up discovering more and researching that a little better. Buffett made a nice move today. He picked up another little bit of Occidental, and curious, because now the amounts that he's just trickling in are just enough to move the stock. With the West Texas Intermediate numbers just moving up a little fraction today, but oil continues to stay under $70. And I think anytime that it's at the mid-60s or thereabouts, we're not much of a commodity player, but you need to be looking at energy. Every time oil drops into that 65 range, find something to invest in. Find a quality, from Marathon to Exxon to BP. Go find something in the category that you can play for a short little term play. We might even decide that we'll drop those gold nuggets on you if we decide we're going to do that the next time. We're still maintaining a healthy cash position in our portfolio, and we're looking at our DPST. We're in it for the third day, and it didn't move anywhere. So unfortunately, it started to move a little bit this morning, but it didn't pull back enough to take us out. And at this point, maybe tomorrow is the day we get taken out, or maybe it bumps a little bit. But either way, we don't want to be leaving our money just go stale in there, because every day it stays in there and we don't make anything, it's costing us a little more in the way the fees work on those ETFs, those leveraged ETFs. That doesn't make good financial sense. So with a little bit of luck, we either jump up tomorrow and we're probably going to go ahead, take our money off the table, or if it does us the service of dropping another % or so, then it's going to take us out with our trailing sell limit. So that's about all the news that's fit to tell today. We'll figure out what the FDIC is going to ultimately do, whether the Warrens and the rest of the nut jobs up on Capitol Hill are going to make some changes into the regulatory environment for the medium-sized banks. Probably wouldn't be a bad idea, and we'll be keeping an eye on that too, because we just love banks around here. Keep your powder dry, take your profits where you can, and be safe out there.